Welcome back to Futures here on the Schwab Network. I'm Alex Coffey, and joining me now is Scott Bauer, the CEO of Prosper Trading Academy. Good morning to you, Scott, and thanks as always for joining us here. Scott, I know you can talk basically any asset, so we're just going to run through them. But to set it up here, we just got through jobs data. We got inflation data this week, and then we got the Fed next week. There's not a ton left on the calendar. Volatility is coming in a lot. What's your general feeling around equities at the moment?
So when you say that volatility is coming in a lot, let me point out two things here. The VIX closed Friday, lowest point in 5 months. It's up a little bit this morning, but not too much. More importantly, or I think most importantly to highlight, is if you look at 1 month S&P options, okay, 1 month S&P options, they are the cheapest they have been except for 2 times in 30 years. So if someone wanted to go out and hedge a portfolio, Alex, and you want to go out 1 month, 6 weeks, whatever it is, you want to take off a little risk if you're worried about end of the year, if you're worried about, maybe the inauguration, the cheapest it has been in 30 years except for 2 times. Now, that being said, my plan would be if you're in the market, you stay long the market. Do you want to get in here as an opening position? That I'm not so sure about. But you stay in and you buy that cheap protection. It is unbelievable, Alex.
Yeah, I was just doing some math while you were talking. If you went to like the 59.70s, for example, in 31 days from now, expiration, that's Jan 9, that would be 2% out of the money. For a 0.5% worth of premium, you can basically hedge a little bit beyond. So 2.5%, you're hedged beyond that if you use something like the S&P 500 puts below. So, I mean, the market totally agreeing with everything you just said in terms of your ability to buy that protection when you can, not necessarily need it. You may never need it, though. That might be why, too. Let's talk gold then as well. Gold obviously had some pressure to it a couple weeks ago. It does seem to be trying to make a comeback. You've talked to us a few times over the last few weeks kind of saying you see a tradable range, dip buying opportunities. But we talked about volatility coming out of the market in equities. I mean, after that big down move, I mean, we haven't had a move outside that range, I mean, since. Not even close.
Exactly, and that's good. That's a good thing to set up a base for the next move higher, in my estimation. So, especially when you look at gold here, we're trading, 2680-ish right now or so. It's made a nice move this morning. I can see us getting back up to the 27.25, 2750 range pretty easily here with volatility, I don't want to say non-existent, but, with volatility just so low. I love when we can set up a base, when we trade in a range and you get some volume, not necessarily volatility. So I still hold that same opinion for gold.
Speaking of a base, it seems in crude oil, this 67 level where we kind of tagged overnight, we finished or settled, I should say, on the Friday session, has been a critical line. Below that, maybe 65. But these rallies are getting smaller and smaller, Scott. The $70 line is not just a magnet now. It seems to be like a rejection zone.
Absolutely, Alex. And as we've spoken, I'm the complete opposite of what I am in gold, where I'm buy the dip there and I'm sell the rip here. I'm just not so sure that we get another rip anytime soon, barring any sort of geopolitical event here. Given the news, especially coming out of China overnight, more weakness, it's absolutely incredible. They just cannot get their economy moving whatsoever. If we break that 67 area, which has been that bottom end of the range here, I think you can see 60 to 62 real quickly in crude.
Yeah, that's another reminder too. I like that you brought in the kind of the China aspect of this. Is that just because stimulus is announced doesn't mean that stimulus is going to work. So, it's really interesting as we just see more and more being announced in China, and then the need for more and more just a few weeks or not months later. It's a never-ending cycle at the moment. So I'll believe it when I see it in terms of a China comeback. But let's talk Bitcoin here. Scott, I know you watch this, but I'm also interested in kind of how Scott Bauer approaches this as an asset. Do you look at some of the proxies, the micro macro strategies, the marathon digitals? Do you look to the asset itself, or is this something you just look at?
If you want to hold Bitcoin as an asset for longer term, great. That's the way to do it. If you want to trade it, if you want to have a tradable proxy, then yes, Coinbase, Mara, some of the other ones that are out there, iBit, Riot is getting some big moves this morning because they were offering some stock. So as a tradable proxy, those are fantastic. You can trade those. The option markets are extremely liquid. So I love trading them. But again, if you're going to look at something holding on longer term, you should go right to the asset itself.
Yeah, and I think we've talked about that. I've certainly talked about with many. We've talked about that with gold. We've talked about that with crude oil. Not to say that they're the same thing, but if you got an opinion on something in particular, sometimes the easiest way, if it's possible, is go directly to that, and that way you can be right if you're right, as opposed to relying on relationships and correlation. All right, final couple thoughts here. We'll combine them. Let's talk dollar and yields. We know that they have this never-ending correlation relationship, and for good reason. What do you make of treasuries at the level we're at, and what do you make of the U.S. dollars? It also kind of ran into a brick wall like 107, 108.
Yeah, it sure did. And, we'll get CPI this week, which is going to be pretty much the last piece of the puzzle for the Fed. I don't think that there's going to be anything that comes out there that is going to change what the Fed does next week. It may change their narrative a little bit if we get a real hot number in terms of what happens going forward into 2025. So I think we see the dollar really steady here over the next, 6 trading days or so, 7 trading days before the Fed meets again. That correlates with rates, and I think we'll see the same thing. This big drop in the 10-year from just a few weeks ago, where we were 440, 450 down to 415, 417 here. This is a very, very comfortable range for the marketplace here. And if the 10-year stays within this range over the next week or so, I think for the equity markets, that's a very positive thing.
Yeah, especially when you see that move lower in bond volatility that we've seen post the election. But the equity market certainly loves to see that. Scott Bauer, appreciate it as always. Have a great week, and we'll talk soon. CEO of Prosper Trading Academy. Always great to get Scott's perspective.